family? Everything fine? So I just found out one of my friends from California is in Waikiki. I'm only going to message her later and be like, hey, you want to hang out? I have another friend coming over later. We're going to go beach if it's okay. It's such a beautiful day today, isn't it? It's like rainy and it smells amazing outside. It's just like, it's fun to see all the people who are in Hawaii and on this live with me. And hey, I'm glad you're so good. So good to see you. So today I'm going to read, and I know you guys, I'm going to read chapter 4 of The Intelligent Investor by Benjamin Graham. It's this book. Okay. And he's going to talk about, and I've never read this, so I'm reading it the first time with you guys. General Portfolio Policy, the Defensive Investor. And the reason I'm doing this is because the stock market's down and everyone says this is the best time to invest, but you can also screw up if you don't know what the hell you're doing. So if you don't know what you are doing. So I'm educating myself. According to Ray Dalio, we're in a big depression, the beginning of a huge depression, which is going to last years. So we have plenty of time to learn how to be good investors. Yeah. So we might as well do it together in happy, fun ways. But before I begin reading the chapter, briefly, I will tell you who I am. My name is May Dildala. I know you know who I am. But Weena knows my name. She knows who I am. But anyone else watching the replay or jumps on YouTube anywhere, my name is May Dildala. I have a blog, yesfinanciallyfree.com. See, Weena might not know that. Yesfinanciallyfree.com is my blog. If you put your first name and your email address on the right side, you get on my email list. And the great thing about that is I give you a free ebook and you get on my email list. The ebook is Working Parents Guide to Financial Freedom. And you also get emails from me when I'm live, what I'll be talking about. So that, and a link, a very convenient little link you can click on to see me live. And that might be cool for you because you might be like, hey, I like that topic. I want to check that out, or I don't like that topic. And you get that privilege when you're on my email list. So go to yesfinanciallyfree.com right now. If you're not on it, put your first name, email address on the right side and get on the email list. Okay. Why would you want to be on my email list? Why would you be interested in me? Well, I'll just tell you my personal story and tell you why I'm interested in financial freedom. I used to suck at money, used to be really bad at it. In fact, Weena on this live on Instagram, you were there during my basic. And during my basic, my goal was to get one of my credit cards to reduce the interest rate to 5%. That was my goal. I had multiple credit card debt at the time. $41,000 was the worst it got on all my credit card debt and line of credit debt. And when I was at that side basic with you, Weena, and you were staffing, my goal was to get one of my credit card interest rates down to 5%. So Weena kind of knows me for a while. I was struggling with money back then. Okay, really struggling. I only made like $34,000 before taxes are taken out as a bank assistant at the time. All right, so that's a huge amount of money. So what happened? All the money, I paid it off by April 2016. Not only that, I was investing the whole time, so we were making a passive income of almost $500 a month. I improved our net worth, family's net worth, by $500,000. I quit my job. We went on 1 month of vacation. I bought our first property 2017, second property 2018, which is an Airbnb business. And then we sold one, bought this nice condo we live in Waikiki right now, 2-bedroom, upgraded our lifestyle. We walked to the beach, whenever we want. We went there yesterday, went boogie boarding. I mean, it's just really nice, And I live in such a nice place. It's just, it gets better and better and better. Thank you, Weena. You're such a sweetie. And I did get my basic goal, so that was pretty cool. It was a little different than I had thought, but it was the same result, so I was happy. So I ended up faxing a letter. Just because Weena's on, I'm going to tell you this story. How did I get my credit card to drop the interest rate from 14.99% to 5%? Well, this is what happened, all right? I faxed a letter to the president of Chase Bank, and I wrote down why I wanted an interest rate that was lower, that I was a good customer, I never missed a payment, and the interest rate is just too high, and I want them to reduce it, and all these reasons, and I talked to so-and-so on this date, and and it's a long letter, very detailed. Okay, I kept track of everyone I talked to ask for this. And then the secretary called me, and she said, you know what, how about this? We'll take your interest rate back to your interest rate before we changed it, which was 8%, and we'll shut down your credit card. However, we'll refund you all the extra interest you paid since that interest rate change, which ended up being like over, I don't know how many $1,000. It was over $1,000. And I was like, yes, because I didn't want to use credit cards anymore anyway. So it was okay with them shutting the credit card down. That was no problem with me. I wasn't using credit anyway. So they shut it down, which means I couldn't charge any more money on it. Not that I hadn't charged in years. And then they refunded me. They refunded me over $1,000 of credit card interest. So it went straight to the card, put the balance down, and I ended up paying that off. So, and they brought the interest rate down to 8.99, whatever. So it wasn't 5, but they refunded interest. So it was kind of the same. So I was happy. So I made my basic goal. That was my second basic goal when I staffed, was to get married, and I got that one too. So it was pretty impressive. So if you haven't taken the basic seminar and you're listening to me, just go online and look at psiseminars.com. Yeah, crazy, right? Isn't that awesome? Awesome story, right? Anyway, so I believe, seriously, I usually put my phone on do not disturb. So a phone call came in, that's why I got paused. I apologize. I should have done that. But anyway, so that's why I blog about financial freedom. And I started coaching clients on how to do that, how to go from bad with money to good with money, basically. How to go from no passive income to having passive income. How to go from working a full-time job to maybe working part-time or quitting or changing to a career you love and still making the same amount of money or more. So that's what I do. And that's what my clients get when they come on my services. Now, if you want to know more about my products and services, go to financiallyfree.com. And there's a tab on the website that says products, and all of my products are there. They range from the full service Finance Freedom Mastermind program, where clients come meet with me once a week with a mastermind. And masterminds are very powerful. I don't know if you've ever been a part of a mastermind, but masterminds, you get together with people, and all you do in this mastermind is work on getting everyone in the mastermind financially free as quickly as possible. So it's a very exciting thing to do every week for 40 minutes live. We also have an extra 1 hour a week online. This is all online. Okay. So if you're all worried about this whole, a pandemic, our business has been online ever since it started. So we're always been online, and that's for other reasons besides a pandemic. It was more for security. It's safer for a female entrepreneur to be online. Would you go figure? I don't have to have security guards to take care of me and stuff if clients get rowdy. Anyway, I have online business. I've always had an online business. So we can help you with that too. We do anything and everything that our mastermind can do to get you financially free as quickly as possible. All right. So if you're interested in that program, it's all at yesfinanciallyfree.com/products. Okay. But you can also go to blog, check it out. You can message me directly if you're interested. That's our highest level program. Every month you have a finance freedom coach that meets with you one-on-one, and you chart your numbers. What are your numbers? You do your income statement and your balance sheet, which is basically your cash flow and your net worth. You figure out how much is in your financial freedom account. You calculate your passive income. You strategize with that coach every month to increase that passive income, increase that net worth, because I believe in wealth, total wealth. You increase your net worth and your passive income at the same time, right? We do not focus on debt, though your debt will be reduced. We focus on wealth. We focus on getting you rich. We focus on getting you financially free. So the whole focus is on that, and that's what the group does. So you get the one-on-one. You also get invited to my annual Christmas celebration for all Finance Freedom Mastermind members. Last year we played cash flow. I have a nice dinner for everyone. We play cash flow. We have fun. It's exciting. And anything else, if there's anything that comes up, I send my members all the information, the recent SBA stuff, unemployment stuff, everything. I send them all that. So if you're interested in any of these products, they range from $0. If you join, no money, join the email list, get the free ebook. Yesfinanciallyfree.com. Yeah. First name, email address, right side of the blog. Free ebook. Get on the email list. That's free. Then there's $7 products all the way up to $5,000. So you go through and look. See what kind of service you want. What level? Are you a DIY kind of person? Do you want someone to hold your hand? Do you want to be part of a group and be warm and fuzzy? We do it all. All right. We do it all, and we're fun and we love it. So thanks for being on. So today we're going to be reading chapter 4 of The Intelligent Investor by Benjamin Graham. And we're going to be talking about general portfolio policy, the defensive investor. Okay. So feel free to watch the replay on my blog. This is everything I'm doing now, Weena, is live on my blog right now. So I have 2 lives simultaneously. Actually, if you're on YouTube, subscribe to the YouTube channel, because every time I go live on YouTube, you get an email. So it's pretty cool. I've been reading this book for the past since last week, Thursday. So we're on chapter 4 already, but I've read up to 4 chapters. And on the blog, I will summarize the book. So if you don't want to actually listen to me read it and you want to get a summary later, just keep track of the blog and I will write up a summary. But I'm reading this for the first time as well. And these lives actually motivate me to learn new things. So I'm using these lives as an excuse to make me read. Ha ha, I'm so clever. Okay. So now that you got the whole spiel, you know who I am. Let's begin. All right. And I hope you guys have an awesome day. Love you. Share this with your friends and followers. Like I said, it's on my blog, which I just told you, and Instagram. My blog, by the way, on Instagram, you just click on the link in my profile and you go straight there too. So it's easy. All right. All right, let's begin. Chapter 4, General Portfolio Policy, the Defensive Investor. The basic characteristics of an investment portfolio are usually determined by the position and characteristics of the owner or owners. At one extreme, we have had savings banks, life insurance companies, and so-called legal trust funds. A generation ago, their investments were limited by law and in many states to high-grade bonds and in some cases high-grade preferred stocks. At the other extreme, we have the well-to-do and experienced businessman who will include any kind of bond or stock in his security list, provided he considers it an attractive purchase. It has been an old and sound principle that those who cannot afford to take risks should be content with a relatively low return on their invested funds. From this, there has developed the general notion that the rate of return which the investor should aim for is more or less proportionate to the degree of risk he is ready to run. Our view is different. The rate of return sought should be dependent rather on the amount of intelligent effort the investor is willing and able to bring to bear on his task. The minimum return goes to our passive investor, who wants both safety and freedom from concern. The maximum return would be realized by the alert and enterprising investor who exercises maximum intelligence and skill. In 1965, we added, in many cases, there may be less real risk associated with buying a bargain issue offering the chance of a large profit than with a conventional bond purchase yielding about 4.5%. This statement had more truth in it than we ourselves suspected, since in subsequent years, even in the best long-term bonds lost a substantial part of their market value because of the rise of interest rates. The basic problem of bond stock allocation. We have already outlined in briefest form the portfolio policy of the defensive investor. He should divide his funds between high-grade bonds and high-grade common stocks. We have suggested as a fundamental guiding rule that the investor should never have less than 25% or more than 75% of his funds in common stocks, with a consequent inverse range of between 75% and 25% in bonds. There is an implication here that the standard division between an equal one or 50-50 between the two major investment mediums. According to tradition, the sound reason for increasing the percentage in common stocks would be the appearance of the bargain price levels created in a protracted bear market. Conversely, sound procedure would call for the reducing the common stock component below 50% when, in the judgment of the investor, the market level has become dangerously high. These copybook maxims have always been easy to enunciate and always difficult to follow because they go against that very human nature which produces the excesses of bull and bear markets. It is almost a contradiction in terms to suggest as a feasible policy for the average stock owner that he lightens his holdings when the market advances beyond a certain point and add to them after a corresponding decline. It is because the average man operates and apparently must operate in opposite fashion that we have had the great advances and collapses of the past. And this writer believes, and we are likely to have them in the future. If the division between investment and speculative operations were as clear now as once it was, we might be able to envisage investors as a shrewd, experienced group who sell out to the heedless, hapless speculators at high prices and buy back from them at depressed levels. This picture may have had some verisimilitude in bygone days. Wow, that's a word I've never heard before. Sorry. I know very means truth, so I understand what they're saying. This picture may have had some truth in bygone days, but it is hard to identify it with financial developments since 1949. There is no indication that such professional operations as those of mutual funds have been conducted in this fashion. The percentage of the portfolio held in equities by the two major types of funds, balanced and common stock, has changed very little from year to year. Their selling activities have been largely related to endeavors to switch from less to more promising holdings. If, as we have long believed, the stock market has lost contact with its old bounds, and if new ones have not yet been established, then we can give the investor no reliable rules by which to reduce his common stock holdings toward the 25% minimum and rebuild them later to the 75% maximum. We can urge that, in general, the investor should not have more than one half of its equities unless he has strong confidence in the soundness of his stock position and is sure that he could view a market decline of the 1969-1970 type with equanimity. It is hard for us to see how such strong confidence can be justified at the levels existing in early 1972. Thus, we would counsel against a greater than 50% apportionment to common stocks at this time. But for complementary reasons, it is almost equally difficult to advise a reduction of the figure well below 50%, unless the investor is disquieted in his own mind about the current market level and will be satisfied also to limit his participation at any further rise to, say, 25% of his total funds. We are thus led to put forward for most of our readers that may appear to be an oversimplified 50-50 formula. Under this plan, the guiding rule is to maintain as nearly as practicable an equal division between bond and stock holdings. When changes in the market level have raised the common stock component to, say, 55%, the balance would be restored by a sale of 1/11 of the stock portfolio and the transfer of the proceeds to bonds. Conversely, a fall in the common stock proportion to 45% would call for the use of 1/11 of the bond fund to buy additional equities. So he's talking about rebalancing. Yale University followed a somewhat similar plan for a number of years after 1937, but it was geared around a 35% normal holding in common stocks. In the early 1950s, however, Yale seems to have given up its once famous formula, and in 1969 held 61% of its portfolio in equities, including some convertibles. At that time, the endowment funds of 71 institutions totaling $7.6 billion held 60.3% in common stocks. The Yale example illustrates the almost lethal effect of the great market advance upon the once popular formula approach to investment. Nevertheless, we are convinced that our 50-50 version of this approach makes good sense for the defensive investor. It is extremely simple. It aims unquestionably in the right direction, gives the follower the feeling that he is at least making some moves in response to market developments. Most important of all, it will restrain him from being drawn more and more heavily into common stocks as the market rises to more and more dangerous heights. Furthermore, a truly conservative investor will be satisfied with the gains shown on half his portfolio in a rising market. A truly conservative investor will be satisfied with the gains shown on half his portfolio. While in a severe decline, he may derive much solace from reflecting how much better off he is than many of his venturesome friends. That's true. If you had half your money in stocks before this great market decline and half in bonds, you would be pretty happy right now. Furthermore, a truly conservative investor will be satisfied with the gains shown on half his portfolio in a rising market. Oh, I got that already. While our proposed 50-50 division is undoubtedly the simplest all-purpose program devisable, it may not turn out to be the best in terms of results achieved. Of course, no path, mechanical or otherwise, can be advanced by any assurance that it will work out better than another. The much larger income return now offered by good bonds than by representative stocks is a potent argument for favoring the bond component. The investor's choice between 50% or a lower figure in stocks may well rest mainly on his own temperament and attitude. If he can act as a cold-blooded weigher of the odds, he would be likely to favor the low 25% stock component at this time. And with the idea of waiting until the Dow Jones Industrial Average dividend yield was, say, 2/3 of the bond yield before he would establish his median 50-50 division between bonds and stocks. Starting from 900 from the Dow Jones Industrial Average and dividends of $36 on the unit, this would require either a fall in taxable bond yields from 7.5% to 5.5% without any change in the present return on leading stocks, or a fall in the Dow Jones Industrial Average to as low as 660 if there is no reduction in bond yields and no increase in dividends. Combination of intermediate changes could produce the same buying point. A program of that kind is not especially complicated. The hard part is to adapt it and to stick to it, not to mention the possibility that it may turn out to have been much too conservative. The bond component. The choice of issues in the bond component of the investor's portfolio will turn about two main questions. Should he buy taxable or tax-free bonds, and should he buy shorter or longer term maturities? The tax decision should be mainly a matter of arithmetic, turning on the difference in yields as compared with the investor's tax bracket. In January 1972, the choice in 20-year maturities was between obtaining, say, 7.5% on grade AA corporate bonds and 5.3% on prime tax-free issues. The term municipals is generally applied to all species of tax-exempt bonds, including state obligations. There was thus for this maturity a loss in income of some 30% in passing from corporate to municipal field. Hence, if the investor was in a maximum tax bracket higher than 30%, he would have a net saving after taxes by choosing the municipal bonds. The opposite. If his maximum tax was less than 30%, a single person starts paying a 30% rate when his income after deductions passes $10,000. For a married couple, the rate applies when taxable combined income passes $20,000. Wow, so different back then. But anyway, it's all good. It is evident that a large proportion of individual investors would obtain a higher return after taxes from good municipals than from good corporate bonds. Well, at least what he's saying is the same. You want to save taxes, even though the tax rates are completely different now. The choice of longer versus shorter maturities involves quite a different question. Does the investor want to assure himself against a decline in the price of his bonds, but at the cost of a lower annual yield, loss of the possibility of an appreciable gain in principal value? We think it best to discuss this question in Chapter 8, The Investor and Market Fluctuations. For a period of many years in the past, the only sensible bond purchases for individuals were the U.S. savings issues. Their safety was and is unquestioned. They gave a higher return than other bond investments of first quality. They had a money-back option and other privileges which added greatly to their attractiveness. In our earlier editions, we had an entire chapter entitled U.S. Savings Bonds, a boon to investors. So we shall point out U.S. savings bonds still possess certain unique merits that make them a suitable purchase for any individual investor. For the man of modest capital with, say, not more than $10,000 to put into bonds, we think they are still the easiest and best choices, but those with larger funds may find other mediums more desirable. Let us list a few major types of bonds that deserve investor consideration and discuss them briefly with respect to general description, safety, yield, market price, risk, income tax status, and other features. Number 1, U.S. savings bonds Series E and Series H. You can actually look these up online, guys. I did. Their yields are extremely low, as you might imagine. We shall first summarize their important provisions and then discuss briefly the numerous advantages of these unique, attractive, and exceedingly convenient investments. The Series H bonds pay interest semi-annually, as do other bonds. The rate is 4.29% for the first year. That would be awesome. It's not that now, guys. You would make more money putting your money in a high-yield savings account than putting it in the savings bond. But we'll just keep reading just for the fun of it. And then a flat 5.10% for the next 9 years to maturity. Interest on the Series E bonds is not paid out, but accrues to the holder through increase in redemption value. The bonds are sold at 75% of their face value and mature at 100% in 5 years, 10 years after 5 years, 10 months after purchase. If held to maturity, the yield works out at 5%, compounded semi-annually. If redeemed earlier, the yield moves up from the minimum of 4.01% in the first year to an average of 5.2% in the next 4, 5, 6 years. Interest on the bond is subject to federal income tax, but is exempt from state income tax. However, federal income tax on the Series E bonds may be paid at the holder's option, either annually as this interest accrues through higher redemption value, or not until the bond is actually disposed of. Owners of Series E bonds may cash them in at any time, shortly after purchase, at their current redemption value. Holders of Series H bonds have similar rights to cash them in at par value cost. Series E bonds are exchangeable for Series H bonds with certain tax advantages. Bonds lost, destroyed, or stolen may be replaced without cost. There are limitations on annual purchases, but liberal provisions for co-ownership by family members make it possible for most investors to buy as many as they can afford. Comment: there is no other investment that combines absolute assurance of principal and interest payments, the right to demand full money back at any time, guarantee of at least a 5% interest rate for at least 10 years. Sorry, I'm laughing at the third one because you cannot get 5% interest rate now. I think it's less than 1% right now. But anyway, holders of the earlier issues of Series E bonds have had the right to extend their bonds at maturity, and thus to continue to accumulate annual values at successively higher rates if they get higher. The deferral of income tax payments over these long periods has been of great dollar advantage. We calculate it has increased the effective net after-tax rate received by as much as a third in typical cases. Conversely, the right to cash in the bonds at cost or better has given the purchasers in former years of low interest rates complete protection against the shrinkage in principal value that befell many bond investors otherwise stated. It gave them the possibility of benefiting from the rise in interest rates by switching their low interest holdings into very high coupon and issues on an even money basis. In our view, the special advantages enjoyed by owners of savings bonds now will more than compensate for their lower current return as compared with other direct government obligations. Other United States bonds. A profusion of these issues exists, covering a wide variety of coupon rates and maturity dates. All of them are completely safe with respect to payment of interest and principal. They are subject to federal income taxes, but free from state income tax. In late 1971, the long-term issues over 10 years showed an average yield of 6.09%. Intermediate issues 3 to 5 years returned 6.35%, and short issues returned 6.03%. In 1970, it was possible to buy a number of old issues at large discounts. Some of these are accepted at par in settlement of estate taxes. The U.S. Treasury 3.5s due 1990 are in this category. They sold at 60 in 1970, but closed in 1970 about 77. So I think what they're saying is you could buy it at $60, even though it's a $100 bond in 1970, and you could buy it at $77 for a $100 bond at the end of 1970. I think that's what he's saying, and they're 3.5%. It's interesting to note also that in many cases, the indirect obligations of the U.S. government yield appreciably more than its direct obligations of the same maturity. As we write, an offering appears of 7.05% of certificates fully guaranteed by the Secretary of Department of Transportation of the Department of Transportation of the United States. The yield was fully 1% more than on direct obligations of the U.S. maturing the same year in 1986. Certificates were actually issued in the name of the trustee of the Penn Central Transportation Company, but they were sold on the basis of a statement by the U.S. Attorney General that the guarantee brings into being a general obligation of the United States backed by its full faith and credit. Quite a number of indirect obligations of this sort have been assumed by the U.S. government in the past, and all of them have been scrupulously honored. The reader may wonder why all this hocus pocus involving an apparently personal guarantee by our Secretary of Transportation and a higher cost to the taxpayer in the end. The chief reason for the indirection has been the debt limit imposed on government borrowing by the Congress. Apparently, guarantees by the government are not regarded as debts, a semantic windfall for shrewder investors. Perhaps the chief impact of the situation has been the creation of tax-free housing authority bonds enjoying the equivalent of a U.S. guarantee, and virtually the only tax-exempt issues that are equivalent to government bonds. Another type of government-backed issues is the recently created new community debentures, offering a yield 7.6% in September of 1971. Number 3, state and municipal bonds. These enjoy exemption from federal income tax. They are also ordinarily free of income tax in the state of issue, but not elsewhere. They are either direct obligations of the state or subdivision, or revenue bonds, dependent for interest payments on receipts from a toll, road, bridge, building, lease, etc. Not all tax-free bonds are strongly enough protected to justify their purchase by a defensive investor. He may be guided in his selection by the rating given to each issue by Moody's or Standard & Poor's, one of 3 highest ratings by both services. AAA, AA, or A should constitute a sufficient indication of adequate safety. The yield on these bonds will vary both with the quality and the maturity, with the shorter maturities giving the lower return. In late 1971, the issues represented in Standard & Poor's Municipal Bond Index averaged AA in quality rating, 20 years in maturity, and 5.78 in yield. A typical offering of Vineland, New Jersey bonds rated AA for A and gave a yield of only 3% on the 1-year maturity, rising to 5.8% to the 1995 and 1996 maturities. Same, municipal bonds, they don't yield that much interest rates. They're not that high, guys. Although they're higher than U.S. Treasury bonds. Maybe. Depends. He's right on the grade, though. Remember during the housing crisis, and a lot of municipalities were going bankrupt and didn't pay back their bondholders, so you can't always trust municipal bonds. Corporation bonds. These bonds are subject to both federal and state tax. In early 1972, those of highest quality yielded 7.19% for a 25-year maturity, as reflected in the published yield of Moody's AAA Corporate Bond Index. The so-called lower medium grade bond issues rated BBB returned 8.23% for long maturities. In each class, shorter-term issues would yield somewhat less than longer-term obligations. Comment: the above summaries indicate that the average investor has several choices among high-grade bonds. Those in high income tax brackets can undoubtedly obtain a better net yield from good tax-free issues than from taxable ones. For others, the early 1972 range of taxable yield would seem to be from 5% on U.S. savings bonds with their special options to about 7.5% on high-grade corporate issues. Wow, go them. I was looking at some high-grade corporate bonds the other day. I think it was like Apple stock. It was like a while ago, maybe a couple months ago. It was yielding like less than 1% or 1% or something really small. It was so low. I was like, again, you can make more putting your money in a high-yield savings account. It was crazy. Higher yielding bond investments. By sacrificing quality, an investor can obtain a higher income return from his bonds. Long experience has demonstrated that the ordinary investor is wiser to keep away from such high-yield bonds. While taken as a whole, they may work out somewhat better in terms of overall return than the quality issues. First, quality issues. They expose the owner to too many individual risks of untoward developments, ranging from disquieting price declines to actual default. It is true that bargain opportunities occur fairly often in low-grade bonds, but these require special study and skill to exploit successfully. These are actually, they call these junk bonds. Perhaps we should add here that the limits imposed by Congress on direct bond issues of the United States have produced at least 2 sorts of bargain opportunities for investors in the purchase of government-backed obligations. One is provided by the tax-exempt new housing issues, and the other by the recently created taxable new community debentures. The offering of new housing issues in July of 1971 yielded as high as 5.8%, free from both federal and state taxes, while an issue of taxable new community debentures sold in September 1971 yielded 7.6%. Both obligations have the full faith and credit of the United States government behind them and hence are safe without question, and on a net basis that yield considerably more than ordinary United States bonds. Savings deposits in lieu of bonds. An investor may now obtain as high an interest rate from a savings deposit in a commercial bank or savings bank, or from a bank certificate of deposit, as he can from a first-grade bond or short maturity. The interest rate on bank savings accounts may be lowered in the future, but under present conditions, they are a suitable substitute for short-term bond investment by the individual. I think short-term saving bonds right now yield less than high-yield savings accounts. But you can always check. Convertible issues. These are discussed in Chapter 16. The price volatility of bonds in general is treated in Chapter 8, the investor and market fluctuations. Call provisions. In previous editions, we had a fairly long discussion of this aspect in bond financing because it involved a serious but little noticed injustice to the investor. In the typical case, bonds were callable fairly soon after issuance and at modest premiums, say 5%, above the issue price. This meant that during a period of wide fluctuations in the underlying interest rates, the investor had to bear a full brunt of unfavorable changes, was deprived of all but a meager participation in favorable ones. Example. Our standard example has been the issue of American Gas and Electric. 100 year 5% debentures sold to the public at 101 in 1928. Wow, okay. 4 years later, under near panic conditions, the price of these good bonds fell to 62.5, yielding 8%. By 1946, in a great reversal, bonds of this type could be sold to yield only 3%. And the 5% issue should have been quoted at close to 160. But at that point, the company took advantage of the call provision and redeemed the issue at a mere 106. The call feature in these bond contracts was a thinly disguised instance of heads I win, tails you lose. At long last, the bond buying institutions refused to accept this unfair arrangement. In recent years, most long-term high coupon issues have been protected against redemption for 10 years or more after issuance. This still limits their possible price rise, but not inequitably. In practical terms, we advise the investor in long-term issues to sacrifice a small amount of yield to obtain the assurance of non-callability, say for 20 to 25 years. Similarly, there is an advantage in buying a low coupon bond at a discount rather than a high coupon bond selling at about par and callable in a few years. For the discount of a 3.5% bond at 63.5%, yielding 7.85%, carries full protection against adverse call action. Interesting. Straight non-convertible preferred shares. Certain general observations should be made here on the subject of preferred stocks. Really good preferred stocks can and do exist, but they are good in spite of their investment form, which is an inherently bad one. The typical preferred stockholder is dependent for his safety on the ability and the desire of the company to pay dividends on its common stock. Once the common dividends are omitted or even in danger, his own position becomes precarious, for the directors are under no obligation to continue paying him unless they also pay on the common. On the other hand, the typical preferred stock carries no share in the company's profits beyond the fixed dividend rate. Thus, preferred holder lacks both the legal claim of the bondholder or creditor and the profit possibilities of a common stockholder or partner. I didn't know that. These weaknesses in the legal position of preferred stocks tend to come to the fore recurrently in periods of depression. Only a small percentage of all preferred issues are so strongly entrenched as to maintain an unquestioned investment status through all vicissitudes. Experience teaches that the time to buy preferred shares is when their price is unduly depressed by temporary adversity. At such times, they may be well suited to the aggressive investor, but too unconventional for the defensive investor. In other words, they should be bought on a bargain basis or not at all. We shall refer later to convertible and similarly privileged issues, which carry some special possibilities of profits. These are not ordinarily selected for a conservative portfolio. Another peculiarity in the general position of preferred stocks deserves mention. They have a much better tax status for corporation buyers than for individual investors. Corporations pay income tax on only 15% of the income they receive in dividends, but on the full amount of their ordinary interest income. Since 1972, corporate rate is 48%. This means that $100 received as preferred stock dividends is taxed only $7.20, whereas $100 received as bond interest is taxed $48. Well, that's a big difference. On the other hand, individual investors pay exactly the same tax on preferred stock investments as on bond interest, except for a recent minor exemption. Thus, in strict logic, all investment-grade preferred stocks should be bought by corporations, just as all tax-exempt bonds should be bought by investors who pay income tax. How interesting. I wonder what the tax laws are now. Security forms. The bond form and the preferred stock form, as hitherto discussed, are well understood and relatively simple matters. A bond holder is entitled to receive fixed interest and payment of principal on a definite date. The owner of a preferred stock is entitled to a fixed dividend and no more, which must be paid before any common dividend. His principal value does not come due on any specified date. The dividend may be cumulative or non-cumulative. He may or may not have a vote. The above describes the standard provisions and no doubt the majority of bond and preferred issues, but there are innumerable departures from these forms. Best known types are convertible and similar issues and income bonds. In the latter type, interest does not have to be paid unless it is earned by the company. Unpaid interest may accumulate as a charge against future earnings, but the period is often limited to 3 years. Income bonds should be used by corporations much more extensively than they are. Their avoidance apparently arises from a mere accident of economic history, namely that they were first employed in quantity in connection with railroad reorganizations and hence have been associated with from the start with financial weakness and poor investment status. But the form itself has several practical advantages, especially in comparison with and in substitution for the numerous convertible preferred stock issues of recent years. Chief of these is the deductibility of the interest paid from the company's taxable income, which in effect cuts the cost of that form of capital in half. From the investor's standpoint, it is probably best for him in most cases that he should have 1. An unconditional right to receive interest payments when they are earned by the company, and 2. A right to other forms of protection than bankruptcy proceedings if interest is not earned and paid. The terms of income bonds can be tailored to the advantage of both the borrower and the lender in the manner best suited to both. Conversion principles can, of course, be included. The acceptance by everyone of the inherently weak preferred stock form and the rejection of the stronger income bond form is a fascinating illustration of the way in which traditional institutions and habits often tend to persist in Wall Street, despite new conditions calling for a fresh point of view. With every new wave of optimism or pessimism, we are ready to abandon history and time-tested principles, but we cling tenaciously and unquestionably to our prejudices. Okay, that's the end of chapter 4 of The Intelligent Investor by Benjamin Graham. So thank you for being on. My name again is May Doldalau. And my blog is yesfinanciallyfree.com. So the replay is there. And I will be writing up a summary, too, after I'm done reading this book. And there's other great things on the blog. Like I said, go here, get on the email list, yesfinanciallyfree.com. Go to the right side, put your first name, email address on the right side, and you can get on the email list. And the email list, I tell people when I will be live, what I'll be talking about. It's a great place to go just to keep updated on things. Go to the products tab on the website to see what products I offer, what services I offer to help you become financially free as quickly as possible. And when you subscribe to the email list, you get a free ebook, Working Parents Guide to Financial Freedom, and you can unsubscribe at any time. So my name is May Doldalau. Thank you so much for being on the live today. I will see you again tomorrow at 8:30 a.m. Hawaii time, 12:30 p.m. Eastern time. Aloha. Take care. Bye, guys. Have a great day. Subscribe to the YouTube channel, okay? If you're on YouTube.